The global banking system is facing a silent exodus that is draining liquidity from traditional financial institutions at a rate not seen since the 2008 collapse, and Bitcoin has just crossed $60,000, while deposit outflows from commercial banks have surged by 12% in a matter of months. This is not a coincidence. This is not market noise. This is the beginning of a fundamental restructuring of where the world stores its wealth. While Federal Reserve officials and central bankers assure the public that the situation is contained and under control, the data tells a very different story. Capital is fleeing the banking system, and it is flowing into an asset that governments cannot print, cannot seize easily, and cannot devalue overnight. The question is not whether this trend will continue. The question is who understands what is happening early enough to position themselves correctly, and who will be left holding worthless paper when the music stops. Right now, at this very moment, thousands of depositors are quietly moving funds out of checking accounts, savings accounts, and money market funds. They are not doing this because of a sudden panic. They are doing this because they have looked at the mathematics of inflation, negative real interest rates, and central bank balance sheets, and they have concluded that their money is safer elsewhere. Bitcoin is not just rising because of speculation or hype. Bitcoin is rising because it represents an exit from a system that has lost credibility. When deposit outflows accelerate and a decentralized digital asset simultaneously rallies to $60,000, you are witnessing a vote of no confidence in the institutions that have managed our money for over a century. This is a liquidity crisis unfolding in slow motion, and the officials telling you everything is fine are the same ones who told you inflation was transitory, who told you subprime mortgages were contained, who told you your deposits were safe, right before multiple bank failures last year. What is happening behind this decision by millions of individuals and institutions to move capital away from banks is a loss of trust that goes deeper than any single policy failure. It is the realization that the system is designed to transfer wealth from savers to debtors, from the prudent to the reckless, from the public to the politically connected. But first, we need to understand how we got here, because this moment did not happen overnight. To understand why this moment is so crucial, we must go back to the financial architecture established in the decades following World War II. The United States emerged from that conflict as the dominant economic and military power on the planet, and it constructed a global financial system with the dollar at its center. Under the Bretton Woods Agreement of 1944, currencies around the world were pegged to the dollar, and the dollar itself was convertible to gold at a fixed rate of $35 per ounce. This system gave Washington unprecedented control over global finance. Countries needed dollars to trade, to buy oil, to settle international debts. The Federal Reserve, in effect, became the central bank of the world. But that system had a fatal flaw. Governments cannot resist the temptation to print money. By the late 1960s, the United States was financing both the Vietnam War and ambitious domestic spending programs by running large fiscal deficits. Foreign central banks, particularly France under Charles de Gaulle, began demanding gold in exchange for their dollar holdings. The U.S. gold reserves were draining fast. In August of 1971, President Richard Nixon closed the gold window, ending the convertibility of dollars to gold and effectively terminating the Bretton Woods system. From that point forward, the dollar was backed by nothing except the full faith and credit of the United States government. What followed was an era of pure fiat currency, where money could be created at will by central banks without any tangible anchor. For a while, this system appeared to work. The U.S. maintained dollar dominance through a combination of military power, economic size, and the petrodollar arrangement with Saudi Arabia and other oil producers, ensuring that global oil trade was conducted in dollars. If you wanted to buy oil, you needed dollars. If you needed dollars, you bought U.S. Treasury bonds. This created a structural demand for American debt and allowed the United States to run persistent trade deficits without immediate consequences. But over time, the incentives embedded in this system led to predictable outcomes. Central banks, freed from the discipline of gold convertibility, expanded money supplies aggressively. The Federal Reserve's balance sheet, which stood at around $800 billion before the 2008 financial crisis, exploded to nearly $9 trillion by 2022. The European Central Bank, the Bank of Japan, and the Bank of England followed similar paths. Interest rates were suppressed to near zero, or even negative in real terms, punishing savers and rewarding borrowers. Asset prices inflated dramatically, creating wealth for those who owned stocks and real estate while eroding the purchasing power of wages and savings. Commercial banks, operating within this system, became heavily reliant on central bank liquidity and government guarantees. Fractional reserve banking allowed them to lend out far more money than they held in actual deposits. As long as confidence remained high and depositors did not demand their money back all at once, the system functioned. But this model contained inherent fragility. Banks were holding long-term assets, like treasury bonds and mortgage-backed securities, funded by short-term liabilities in the form of deposits that could be withdrawn at any time. When interest rates finally began to rise in 2022 and 2023 to combat inflation, the value of those long-term assets plummeted. Banks were sitting on massive unrealized losses. For decades, this system seemed unshakable. But something changed. The cracks became visible in March of 2023, when Silicon Valley Bank collapsed in the second-largest bank failure in American history. Depositors, spooked by news of unrealized losses and declining asset values, rushed to withdraw their funds. Within 48 hours, the bank was insolvent. Signature Bank failed days later. First Republic Bank followed in May. These were not small regional institutions. These were banks with hundreds of billions of dollars in assets, deeply integrated into the financial system. The Federal Reserve and the Treasury Department intervened with emergency lending facilities and guarantees, but the message was clear. The banking system was far more fragile than anyone had publicly admitted. What official statements called an isolated incident was, in reality, a warning sign of systemic stress. The underlying problem, unrealized losses on bank balance sheets due to rising interest rates, did not go away. According to data from the Federal Deposit Insurance Corporation, U.S. commercial banks were sitting on over $500 billion in unrealized losses on securities as of the end of 2023. That figure represents a massive hole in the capital base of the banking system. Banks cannot lend aggressively when their balance sheets are impaired. They become risk-averse, tightening credit conditions even as the economy needs liquidity. At the same time, depositors began to notice something troubling. The interest rates offered on savings accounts and checking accounts remained near zero, even as the Federal Reserve raised its policy rate to over 5%. Inflation was running at levels not seen in 4 decades, meaning that money sitting in a bank account was losing purchasing power at a rate of several percent per year. Real interest rates, the nominal rate minus inflation, were deeply negative for ordinary savers. Meanwhile, money market funds and treasury bills were offering returns above 5% with virtually no risk. The rational response for any depositor was to move money out of banks and into higher-yielding alternatives. And that is exactly what happened. Deposit outflows from commercial banks accelerated throughout 2023 and into 2024. According to Federal Reserve data, total deposits at U.S. commercial banks have declined by over $1 trillion from their peak in early 2022. This represents a 12% reduction in the deposit base, the largest and fastest decline in modern history outside of a major financial crisis. Banks are losing their cheapest source of funding, the deposits that they pay little or no interest on, and are being forced to replace them with more expensive borrowing from the Federal Reserve or wholesale funding markets. This is a liquidity squeeze in real time. Banks have less money to lend. Credit conditions tighten. Economic activity slows. The feedback loop is self-reinforcing. As deposits leave the system, banks become weaker, which makes depositors even more nervous, which accelerates outflows. The Federal Reserve can provide emergency liquidity through its discount window and other facilities, but that does not restore confidence. It simply papers over insolvency with more printed money. Now, against this backdrop of a banking system under stress, Bitcoin has surged to $60,000. This is not happening in a vacuum. Bitcoin represents something fundamentally different from the fiat system. It is a decentralized digital asset with a fixed supply cap of 21 million coins. No central bank can print more Bitcoin. No government can unilaterally devalue it through monetary policy. It operates on a transparent blockchain where every transaction is recorded and verifiable. For individuals and institutions losing faith in the traditional banking system, Bitcoin offers an alternative, a way to store value outside the reach of central banks and commercial banks that have proven themselves unreliable. The timing of Bitcoin's rally is not coincidental. As deposit outflows from banks accelerate, inflows into Bitcoin are surging. Spot Bitcoin exchange-traded funds, approved by the Securities and Exchange Commission in January of 2024, have seen tens of billions of dollars in net inflows. These are not retail speculators buying lottery tickets. These are institutional investors, pension funds, family offices, and high-net-worth individuals making strategic allocation decisions. They are diversifying away from a banking system they no longer trust and into an asset that exists outside that system entirely. What traditional media is not reporting is the degree to which this trend is coordinated and deliberate. Behind the scenes, there are conversations happening at the highest levels of finance about the viability of the current monetary system. Hedge fund managers, sovereign wealth funds, and corporate treasurers are quietly building Bitcoin positions as a hedge against currency, debasement, and financial system fragility. Countries that have been shut out of the dollar system through sanctions, like Russia and Iran, have been accumulating Bitcoin and other cryptocurrencies as a way to bypass Western financial infrastructure. Even some central banks are reportedly exploring Bitcoin as a reserve asset, though few will admit it publicly. The narrative from regulators and policymakers has been dismissive. They call Bitcoin volatile, speculative, a tool for criminals. But this narrative is losing credibility, as the banking system itself shows signs of instability. When your bank can fail overnight and your deposits are only insured up to $250,000, suddenly the volatility of Bitcoin does not seem so scary. When inflation is eroding your purchasing power at 7 or 8% per year, a 5 or 10% drawdown in Bitcoin looks like noise. The risk calculus is shifting. And there is something else happening that is crucial to understand. The U.S. government is heavily indebted, with a national debt exceeding $34 trillion and rising. Servicing that debt at current interest rates is consuming an ever larger share of the federal budget. The only way to manage this debt burden without defaulting is to inflate it away, to let rising prices erode the real value of the debt over time. This requires keeping interest rates low relative to inflation, which means negative real rates for savers. The Federal Reserve is trapped. If it raises rates too high, it crashes the economy and the banking system. If it keeps rates too low, inflation runs out of control and destroys confidence in the currency. Bitcoin offers an escape from this trap. It is not subject to the political pressures that central banks face. Its supply is algorithmically determined and cannot be changed by a committee vote or an executive order. As more people come to understand that their wealth is being quietly confiscated through inflation and financial repression, the appeal of Bitcoin grows. This is not a speculative mania. This is a rational response to a system that has broken its social contract with savers. The connection to broader global trends is also significant. The world is moving away from a unipolar system dominated by the United States and toward a multipolar world where power is more distributed. Countries in Asia, the Middle East, and Latin America are increasingly conducting trade in currencies other than the dollar. China and Russia are building alternative payment systems to bypass SWIFT, the Western-controlled financial messaging network. Central banks around the world are buying gold at the fastest pace in decades, diversifying their reserves away from dollars. Bitcoin fits into this broader trend of de-dollarization and financial sovereignty. What we are witnessing is not just a rally in the price of Bitcoin. We are witnessing the early stages of a migration of wealth from a centralized, government-controlled financial system to a decentralized, individual-controlled alternative. The 12% drop in bank deposits is not a blip. It is a signal. It tells us that confidence in the old system is eroding faster than most people realize. Capital is searching for safety, and it is not finding it in traditional banks or government bonds. It is finding it in assets that cannot be manipulated by monetary policy. The officials who tell you that this situation is contained are either misinformed or lying. The data does not support their narrative. Deposit outflows are accelerating, not slowing. Bank balance sheets remain impaired. Credit conditions are tightening. And all the while, Bitcoin is rallying to levels that were unthinkable just a few years ago. This is not a coincidence. This is cause and effect. The failure of the banking system is driving the success of Bitcoin. At this point, I need to step back from emotion and look at this through a realist lens. In the study of international relations and political economy, there is a well-established framework for understanding how states and institutions behave under conditions of systemic stress. The core insight is that actors operate in an anarchic environment, where there is no higher authority to enforce rules or guarantee security. In such an environment, survival is the primary goal, and power is the means to achieve it. Trust is scarce, and commitments are only as good as the power behind them. Apply this logic to the current financial system. The United States has held monetary hegemony for over 70 years, and it has used that power to advance its interests, financing deficits by issuing debt that the rest of the world must hold, imposing sanctions on adversaries by cutting them off from the dollar system, and inflating away its debt burden through monetary expansion. This is rational behavior for a hegemon. But hegemony is not permanent. When a dominant power abuses its position, weaker actors begin to search for alternatives. They hedge, they defect, they build parallel systems. Bitcoin is the ultimate hedge in a world where trust in centralized institutions is declining. It does not require you to trust a government, a central bank, or a commercial bank. It requires you to trust mathematics and cryptography. For states that have been sanctioned, for individuals who have seen their savings destroyed by hyperinflation, for institutions that have watched banks fail despite government assurances, Bitcoin offers a credible alternative. It is not controlled by any single actor, which means it cannot be weaponized in the same way the dollar has been. From a realist perspective, the current crisis in the banking system was predictable. When you combine fractional reserve banking, fiat currency, and political incentives to inflate, you create a system that is inherently unstable. The only thing holding it together is confidence, and confidence is a fragile thing. Once it breaks, it is very difficult to restore. The bank runs of 2023 were a break in confidence. The 12% deposit outflow is a continued break in confidence, and the rally in Bitcoin to $60,000 is a vote by the market that the old system is no longer trustworthy. The mistake that many analysts make is assuming that governments and central banks can simply decree confidence back into existence. They cannot. They can provide liquidity. They can guarantee deposits. They can lower interest rates. But none of these measures address the underlying problem, which is that the system has created more liabilities than it can possibly honor at current purchasing power. The math does not work. Either those liabilities get defaulted on explicitly through bank failures and government insolvency, or they get defaulted on implicitly through inflation that destroys the real value of money. Bitcoin is a bet that the implicit default is already underway. It is a bet that central banks will choose inflation over deflation, that they will print money to avoid immediate collapse, and that this will erode the value of fiat currency over time. So far, that bet has proven correct. Every time the Federal Reserve expands its balance sheet, every time the government runs $1 trillion deficit, every time a bank requires a bailout, Bitcoin's value proposition becomes stronger. The realist framework also helps us understand why governments are increasingly hostile to Bitcoin. It represents a challenge to their monetary sovereignty. If people can opt out of the national currency and store wealth in a decentralized alternative, then governments lose the ability to tax through inflation. They lose the ability to impose capital controls. They lose leverage. This is why China banned Bitcoin mining and trading. This is why the U.S. Securities and Exchange Commission has been aggressive in regulating the cryptocurrency industry. This is why central banks are rushing to develop their own digital currencies, so-called CBDCs, which would give them even more control over the monetary system. But here is the crucial point. Governments can regulate, they can restrict, they can even ban, but they cannot stop a decentralized network that operates across borders and exists on thousands of computers around the world. Bitcoin is resilient precisely because it is not controlled by any single point of failure. Every attempt to suppress it has failed. Every ban has been circumvented. The network keeps running. Blocks keep being mined. Transactions keep being processed. This is the power of decentralization. From a strategic standpoint, the smartest actors in the system are the ones positioning themselves early. They understand that the old financial order is in decline and that something new is emerging. They are not waiting for permission from regulators or validation from mainstream institutions. They are acting on the realization that the ground is shifting beneath their feet. This is how power transitions happen, not through formal announcements or treaties, but through incremental shifts in behavior as actors quietly defect from the old system and build positions in the new one. The implications of this analysis are profound. If Bitcoin continues to rise while bank deposits continue to fall, we are looking at a structural shift in how the world stores value. This is not a temporary dislocation. This is a trend that could accelerate over the next 5 to 10 years, especially if we see more bank failures, more inflation, more currency crises in emerging markets. Each new crisis will validate the decision to hold Bitcoin. Each bailout will prove that the system is broken. This is not just about the United States or Bitcoin. The consequences will affect every country that participates in the global financial system. For nations that are heavily dollarized, a loss of confidence in the dollar means their own economies are at risk. For countries that hold large reserves of U.S. Treasury bonds, a devaluation of the dollar through inflation means a loss of wealth. For ordinary people trying to save for retirement or protect their families, the erosion of purchasing power is a quiet theft that happens every day. Economic predictions are never certain, but the direction of travel is clear. Energy prices remain elevated due to geopolitical tensions and underinvestment in fossil fuels. Food prices are rising due to supply chain disruptions and adverse weather. Housing costs are out of reach for an entire generation. Central banks are trying to navigate between the rock of inflation and the hard place of recession, and they are failing. Inflation is proving more persistent than they expected. Growth is slowing. Unemployment is starting to tick up. Stagflation, the nightmare scenario of the 1970s, is back on the table. In this environment, holding cash is a losing strategy. Holding bonds is risky because interest rate volatility can wipe out years of gains. Holding stocks is precarious because valuations are stretched and corporate earnings are under pressure. Real estate is illiquid and expensive. Gold is a traditional hedge, but it is hard to transport and difficult to use in transactions. Bitcoin offers liquidity, portability, and scarcity. It is not perfect. It is volatile. But for a growing number of people, it is the best available option in a world where all the alternatives are compromised. Political ramifications are also unfolding. In the United States, there is increasing polarization around monetary policy and the role of the Federal Reserve. Some lawmakers are calling for audits of the Fed, for restrictions on its power, for a return to sound money principles. Others want even more aggressive intervention, more stimulus, more spending. The consensus that held the system together for decades is fracturing. In other countries, populist movements are rising in response to economic hardship, and many of them are questioning the legitimacy of central banks and the international financial system. Bitcoin has become a symbol for some of these movements. It represents a rejection of the status quo, a belief that individuals should have control over their own money without interference from governments or banks. This is why it resonates, especially with younger generations who have watched their parents' savings eroded by inflation, who have seen banks bailed out while ordinary people suffer, who have grown up in an era of zero interest rates and skyrocketing asset prices that benefit the already wealthy. Security calculations are also shifting. If a significant portion of global wealth moves into Bitcoin, it changes the balance of power. Countries that embrace Bitcoin early gain a strategic advantage. Countries that resist it risk being left behind. Some nations, like El Salvador, have already made Bitcoin legal tender, a bold experiment that is being watched closely. Others are exploring Bitcoin mining as a way to monetize stranded energy resources. Still, others are quietly accumulating Bitcoin as a hedge against dollar dominance. The international financial system faces a crisis of legitimacy. For decades, it has operated on the assumption that the United States would manage the dollar responsibly, that central banks would maintain price stability, that commercial banks would act as safe custodians of deposits. All of these assumptions are now in doubt. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created in 1913. Central banks have consistently missed their inflation targets. Banks have failed despite promises that they were sound. The system has broken its promises. In the next 5 to 10 years, we will see more countries diversifying away from the dollar, more individuals moving wealth into Bitcoin, and more strain on the traditional banking system. This does not mean the dollar will disappear overnight or that all banks will collapse, but it does mean that the unipolar financial order centered on the United States is eroding. Power is diffusing. Alternatives are emerging. The world is becoming more multipolar, not just in geopolitical terms, but in monetary terms as well. For individuals, the message is clear. Do not assume that the institutions you have trusted will be there to protect you. Do not assume that your deposits are safe simply because they are insured up to a certain amount. Do not assume that inflation is transitory or that central banks have everything under control. The evidence suggests otherwise. Deposit outflows are accelerating. Bank balance sheets are impaired. Bitcoin is rallying to $60,000. These are not random events. They are connected. They tell a story of a system in transition. The choice you face is whether to recognize this transition early and act accordingly, or to wait and hope that things return to normal. History suggests that waiting is the more dangerous option. When confidence in a monetary system erodes, it does not come back easily. When wealth starts to migrate from one asset class to another, those who move early benefit, and those who move late pay a price. This is not investment advice. This is an observation about the structure of the situation we are in. Bitcoin has demonstrated that a decentralized alternative to the traditional banking system is not only possible, but increasingly attractive. What we are witnessing is not a speculative bubble driven by irrational exuberance, but a rational reallocation of capital away from institutions that have lost credibility. The 12% deposit outflow from banks is a symptom of this deeper loss of trust. The rise of Bitcoin is the consequence. As the framework of political realism would predict, when institutions fail to provide security and stability, actors seek alternatives. They hedge, they diversify, they defect. This is exactly what is happening now. The banking system is failing to provide the security and stability that depositors expect. Bitcoin is emerging as the alternative. The trend is clear. The question is not whether it will continue, but how fast it will accelerate. This move marks a turning point in the history of money. We are living through the early stages of a transition from centralized fiat currency controlled by governments to decentralized digital assets controlled by individuals. The outcome of this transition is not yet determined. Governments will fight to preserve their monetary monopolies. Established financial institutions will resist disruption, but the forces driving this change, loss of trust, technological innovation, and the inherent instability of fiat currency systems, are powerful and persistent. The unipolar world of dollar dominance is fracturing, and Bitcoin is positioning itself as a key player in the multipolar monetary reality that is emerging. Who gets left holding the bag? Those who ignore the warning signs. Those who trust official assurances over observable data. Those who assume that the system will somehow fix itself without fundamental change. The officials say the situation is contained. The chart disagrees. The exodus from banks is real. The rise of Bitcoin is real, and the crisis of confidence in the global financial system is real.